So this is our first video. First thing to mention is that this file is posted to Canvas so that you can access it and follow along during the video. Second thing to note is that I pulled this information from Morningstar, which North Park has a premium subscription to that you can access via the online resources of the Brandell Library. That little tidbit may help you in many of your classes during your studies here at North Park. The third thing to note is that this video is likely to be a little bit longer than the others, both because the income statement is so important and because I want to show you a particular approach that we use. So feel free to pause this video, rewind it, pause again, go outside, run around the block, and get your headspace where you need it to be, because the income statement is going to start off with what we call top line, meaning revenues. The important thing about that is those are the only cash flows in of substance that are really noted upon the income statement. We next move to cost of revenue, sometimes called cost of goods sold. You would have studied this in your financial accounting class, whereby the direct materials and direct labor that go into producing the product that is sold is accounted for. And then the first subtotal that we get to, that I'm going to put in italics here, is going to indicate for us the amount of money that is left over after we collected our revenue and pay for the cost of the revenues. This particular subtotal, meaning the previous line less the one immediately above, is going to repeat itself through the income statement. Then we get into our categories of operating expenses, which would include things for Facebook like research and development for their new sites and functionalities. The big catch-all category would be sales, general, administrative, which would include everything from consulting to insurance to rent to advertising and promotions, but also embedded in this is something we'll come back to, which is depreciation. So we end up with total operating expenses, and once then we get into our total operating expenses, we then have a total that we can use to calculate operating income, where operating income is just going to be equal to all of our gross profit subtracting off our operating expenses. Then we take into account the effects of borrowing, which would be interest expense. There's a catch-all category for others, and then those two things are subtracted to be into what we call income before we take away income taxes. Provision for income tax is then corporate tax. This will be interesting to watch going into 2018 as our administration has changed corporate tax laws. And then net income, what I always think of as quote unquote the answer on the income statement, is then the amount of profit that this business produces using an accrual accounting basis. We then use that answer to calculate earnings per share, where earnings per share then is going to be simply the amount of net income divided by the shares outstanding. And we tend to take a look at what's called basic earnings per share. And what that indicates is that in 2017, every shareholder of Facebook would be quote unquote entitled to a $5.49 payout if Facebook chose to give away all the profits that it had generated. But down at the bottom, we see something called EBITDA. And EBITDA is earnings before interest expense, tax expense, depreciation, and amortization expenses. That's a critical line for us in finance, because what it allows us to think about is how much cash this business generates if we didn't have to worry about paying debt. Let's say it has debt, but we choose to pay that debt off if we were to acquire the firm. It chooses to factor out tax because different companies could organize different tax structures in different locations that would affect taxes differently. And then it adds back that idea of depreciation, which is a non-cash expense that distorts the amount of true cash creation. Because as you will find in this class, Kaminsky says, cash is king. With that basic walkthrough, and one that you should have had in your financial accounting class, let's go ahead and toggle over the income statement, and let me show you a condensed version of it that we're going to use repeatedly in this class. So toggling over to the second sheet, the income statement that we'll just make up quickly for a company, it's going to look something like this. So let's say we start off with revenues, and we'll keep it simple, and we will make it $100,000 worth of revenues. That revenue then has a cost of revenues associated with it, just like in our previous walkthrough, and we'll say that that's $75,000, which is something I'm going to need to format here because Facebook or my income statement here is picking up the formatting that I had in Facebook before, and I don't want that. Okay, so that leaves us with gross profit. This is the first time we get a basic subtotal of the previous subtotal, or in this case, top line revenues, minus our cost of revenues. And then I'm going to put a nice little line underneath it so that every time you see a line, you can indicate that that was a subtotal above. We then said that operating expenses are what's going to come out next. So we'll say that was $5,000. We are then going to do another subtotal, gross profit minus operating expenses. Put a line there to indicate a subtotal. And we call that thing then EBITDA. That's a slight change in the way that it was presented before, where I'm moving EBITDA from the very bottom of the income statement, like Morningstar shows, up to the top so that it's part of the layout of the income statement. From that, then, we can subtract depreciation expense. Say depreciation expense was $2,000. And thereby, we get what's called EBIT, which is, again, another subtotal, where EBIT then stands for earnings before interest expense and tax. See how we went from EBITDA, we subtracted off the D and A, and we got to EBIT. So now what do we need to do? We're going to take off our interest expense. So if we have interest expense, let's say of $2,000, that becomes another subtotal for what is then called oftentimes EBT, or earnings before tax. This is where finance can get a little tricky for some novices, in that EBT, earnings before tax, is really a synonym for this here, income before tax, earnings before tax. It can be a little tricky for new people to have to adjust to multiple sets of verbiage for the same basic concept. But it's from EBT that we take away taxes. So let's say our taxes were 25% of our EBT. That will then give us another subtotal, which is actually our last total, which would be net income. So let's say we had a number of shares of 5,000 in this particular case. What I like about finance in the current form is that we can go out to basic websites to find the information that we need. And one of my favorites is Investopedia. It's the Wikipedia for finance. So if we wanted to look up something like earnings per share, it's like looking up in the old encyclopedia, which I grew up with, to find out what the different formulas are that relate to basic earnings per share. So if we go and we find what that formula is, we're going to see that earnings per share is going to be equal to net income divided by shares. So our EPS would be equal to the amount of profit that each shareholder would have the ability to reclaim. So I would suggest you get to know this particular form of the income statement, because we're going to use it repeatedly later on in the course to understand the way that corporations and nonprofits think about an income statement from more of a finance point of view. So there's our first video. It's got the file for you to access. It was a little bit longer than most of the others will be, but hopefully it was a helpful walkthrough in getting you up to speed on the income statement.